Two people crossed $1 million the same week. One of them is about to lose $2 million more, and it starts with an email that says, "Congratulations." Welcome back to Flowcraft Invest, the channel where we take the number in your account and figure out what everyone else is about to do with it. Two people crossed $1 million in net worth in the same spring 4 years ago. Same round number, same disbelieving screenshot. 25 years later, one of them has $2.3 million more than the other, and the one who ends up behind is the one who took more action, not less. Here's the part that should bother you. The reason isn't really a decision either of them made on purpose. It's an invitation that got mailed to one of them in month 4, engraved, RSVP requested. It never reached the other one at all. The number lies to you twice. $1 million is not the milestone your brain thinks it is, and it's not evenly distributed the way you assume either. Cross $1 million in net worth in the United States, and you land somewhere around the top 10–12% of households. Comfortable, rare, but nowhere near the made it tier your brain files it under. You're not in the room where decisions get made. You're in the waiting area outside it, and the waiting area has really nice chairs. But the milestone is real in one specific way. $1 million invested at a conservative real return throws off somewhere around $70,000 a year without you doing anything at all. That's the first point in your financial life where your money's own effort starts rivaling your salary. Your snowball isn't just rolling anymore, it's picking up its own weather. Which is exactly why this is the worst possible moment to stop paying attention to it. The only question that matters in month 1 sounds like bookkeeping. Where is it sitting? It isn't bookkeeping. Where your money sits determines who can see it, who gets paid to manage it, and whether you can actually spend any of it without triggering a tax event, a penalty, or an awkward family conversation. Odalys sat in 2 boring index funds and didn't think about the number much at all. Same contribution, same day, every month, mostly on autopilot. Desmond did the thing that looks the most impressive on paper. He'd bought a duplex in his late 20s, refinanced into a rental condo a few years later, and let a decade of appreciation carry him past 7 figures. His net worth statement says $1,010,000. In the most literal sense, it's 2 roofs, 2 tenants, and $180,000 sitting in a savings account he'd been meaning to put to work. Real estate concentrated like this has fascinating properties as an asset. You can't sell 4% of a duplex to cover a bad month. You're not diversified. One metro area, one local job market, one set of tenants who may or may not pay in a recession. And that $180,000 of idle cash was about to become the most interesting number he owned. 2 people, 1 threshold, and neither of them knows yet that the threshold itself is the event. Month 4. Desmond's savings balance, the idle $180,000, separate from the properties, crosses the private banking threshold at his institution. Friday morning, an email arrives from the bank's private client division, a title that didn't exist for him 11 months earlier when the balance was 1/3 of that. It's warm, it mentions a complimentary portfolio review, there's a name attached, a direct phone line, and a calendar link with 3 open slots this week. Nobody sends Odalys anything like this because her money sits inside index funds at a discount brokerage that has no reason to call her. There's no product to sell, no assets to move, no commission sitting on the table. Both of them crossed the same overall net worth line in the same season. Only one phone rang because $1 million to $2 million in investable assets is exactly the tier where private banking and alternative investment funds clear their minimums, and where certain offers start getting generated automatically based on account balance data nobody remembers agreeing to share Desmond. Desmond didn't apply, he became eligible, and eligibility gets sold. Hold on to that email. Nothing evil happens in it by itself. It's a coffee meeting and a pizza. But almost everything Desmond loses over the next 2.5 decades traces back to that one unsolicited invitation, and mostly not through the relationship manager, through what the relationship manager sells him access to. The private client rep doesn't pitch mutual funds. Desmond's balance is already too big for that conversation to feel exciting to either of them. Instead, 6 weeks in, he's introduced to something with a name like a boutique hotel, a private credit fund, double-digit target returns, not correlated to the public markets, A minimum check size that happens to be almost exactly the $180,000 sitting idle. It's not a scam. It's real. It's legal. It's SEC filed. And thousands of advisors place clients into funds just like it every year. It also locks his money up for 7 years, charges a 2% management fee plus 20% of any gains, and reports its own returns on a schedule the fund itself controls. Run $180,000 two ways over 25 years. In a low-cost index fund at roughly 7% real after a 0.04%.
Expense ratio, about $963,000. In the private fund, reported at 9%, but net of the 2 and 20 structure once the real cash flow adjusted return is backed out, closer to 6.5%, landing around $729,000. That gap, roughly $234,000 on this slice alone, didn't disappear because Desmond made a bad bet. It disappeared into a fee structure built for exactly this moment. A large idle balance, a warm relationship, and a client who now believes regular index funds are for people with less money than him. The fund isn't Desmond's only bill. Year 2, after crossing the million mark, his rental condo needs a new roof and the duplex needs a kitchen update to stay competitive with newer listings nearby. A contractor he trusts quotes $58,000. He pulls it from a home equity line against the duplex. 7.9%, interest only for the first 3 years. Totally standard. It is standard. It's also how illiquid wealth becomes leveraged illiquid wealth. 6 months later, a plumbing issue at the condo becomes an emergency, and there's no cash cushion left to absorb it because the cushion is locked in the fund and the equity is already spoken for by the HELOC. To cover it, Desmond pauses his brokerage contributions for 14 months. The only line in his budget that doesn't send an angry letter when you skip it. Odalys' phone rang exactly 0 times. Nobody offered her a private fund because her money sat somewhere that generates no placement fee. Nobody offered her a home equity line at a relationship rate because she didn't own concentrated real estate to leverage. She kept adding the same amount to the same 2 funds on the same day every month, mostly on autopilot, mostly without an opinion about it. She wasn't disciplined in any dramatic sense. She was, if anything, a little disengaged. She genuinely forgot her brokerage password twice and had to reset it. The tidy version of this story says the boring one won because of willpower. That's not really what happened. She won because nothing found her. Her money sat somewhere with no margin in it for anyone else, so nobody spent effort finding her. 25 years out, running the same starting net worth, same salary, same starting date? Odalys, $1 million start, boring index funds, no interruptions, $5.4 million. Desmond, $1,010,000 start, real estate plus the fund plus the HELOC plus the 14-month pause it forced, $3.15 million. Odalys ends up $2.32 million ahead. Break down Desmond's gap the way people usually get this wrong, by stacking causes instead of isolating them, and you double count. The honest split. The fund's fee structure accounts for about $1.05 million of the total. Its cost compounds over 25 years, not just on the original 234K slice. The HELOC drag and the 14-month contribution pause together account for the remaining $1.27 million, a separate mistake that only happened because the first one had already eaten his cash cushion. Neither of these two people did anything a stranger would call reckless. Nobody bought anything wild. Every decision, examined on its own, on the day it was made, looked reasonable. That's the actual lesson, and it's less satisfying than don't be greedy. The $1 million threshold doesn't attract bad decisions. It attracts good-looking decisions, wrapped by people whose entire job is making the next step feel like the obvious one. Precisely because a balance somewhere just told the database that Desmond could now afford to make it. The number in the account didn't make Desmond careless. It made him findable. And the only one who didn't get found was the one whose money sat somewhere with nothing to sell. So here's the 4-minute exercise. Same as always. Go look at where every dollar of your net worth
actually sits right now, and ask who else can see that it's there. If the honest answer is a lot of people, and most of them have my email, that's not a compliment. That's a target painted on a good decade of compounding. Keep doing the boring thing. It was working. That's exactly why they called. That's the whole thesis. The danger isn't the mistake, it's the moment you stop being invisible to the people paid to find it. If this saved you from a phone call you haven't gotten yet, hit subscribe. That's how Flowcraft Invest stays ad-funded instead of sponsored by funded. Next week, what happens the moment your net worth crosses $10 million and why the offers get quieter, not louder. I'm out. Go check where your money actually sits.